How to use Bollinger Bands for options trading. Are you curious about how to use Bollinger Bands in your options trading strategy? You're in the right place. Let's break it down in a simple way. Bollinger Bands are a popular tool in technical analysis. They help traders spot potential price movements and volatility in stocks. The bands consist of 3 lines: a middle band, which is usually a 20-day moving average, and an upper and lower band that are set a certain number of standard deviations away from the middle band. These bands expand and contract based on market volatility. When you look at the stock price in relation to the Bollinger Bands, you can make informed decisions. If the stock price is near the lower Bollinger Band, it often means the stock is oversold. This situation suggests a potential price increase. As an options trader, you might consider buying call options to profit from this expected rise. On the other hand, if the stock price is near the upper Bollinger Band, it may indicate the stock is overbought. This signals a possible price reversal downward. In this case, buying put options could be a better choice to benefit from a potential price decline. Now, what if the stock price is trading in the middle of the bands? This scenario might lead you to consider neutral strategies. You could think about covered call writing or selling cash-secured puts since the price is not showing a strong directional bias. Bollinger Bands also help identify volatility patterns, which are important for options pricing. A Bollinger Band squeeze occurs when the bands contract tightly, indicating low volatility. This often comes before a significant price breakout. Options traders can prepare for potential large moves by purchasing options that would benefit from increased volatility, like long straddles or strangles. When the price moves outside the upper or lower bands, it signals a strong trend continuation. If the price breaks above the upper band, traders can enter long positions with call options. Conversely, if it breaks below the lower band, short positions with put options may be appropriate. Always remember to manage your risk with stop-loss orders. Another interesting pattern is the Bollinger Band walk. This happens when the price walks along the upper or lower band during a strong trend. Options traders can enter and exit positions multiple times. For example, you might buy calls on bounces off the upper band in an uptrend or puts on bounces off the lower band in a downtrend. When managing your options trades based on Bollinger Bands, hold your position as long as the stock price stays on the expected path. If the stock price crosses the middle band, it may signal a potential reversal, and you might want to consider exiting or adjusting your position. Use the bands as potential exit points. For instance, if you bought a call near the lower band, targeting the middle or upper band could be a good profit-taking level. Bollinger Bands provide options traders with a framework to anticipate price reversals, trend continuations, and changes in volatility. By combining these signals with appropriate options strategies, such as buying calls or puts near the bands, traders can align their trades with expected market behavior and manage risk effectively.